We are being joined by Shibani Sircar, who is joining us from Kotak, as well as we do have Naresh. And good afternoon to both of you. Naresh, let me come to you first to know the levels that we should watch out for. Nifty 50, 22,800. Once again retested. What does it mean for Nifty 50?
And we are not seeing selling pressure on the large caps beyond that point. But if you look at the small cap and the mid cap indices, we have broken those levels and we are almost equivalent to a level of 21,900 to 21,500 on the small cap and mid cap indices. So we are getting oversold over there. But till the time we don't get a sharp recovery, we do not call it a bottom as such. On the Nifty below 22,700, 800, the next price point comes closer to that 22,000 to 22,230 mark, which is where we roughly closed on the day of closer to 22,000 mark where we closed on the election day lows. So overall would not expect that to break. So we are getting into a phase wherein this could get oversold and find a bottom somewhere in this band. So overall small caps and mid caps have taken a larger hit. Index is still holding on and we've not seen the breadth being terrible in the large cap indices.
Right, should hold on to these levels entering that oversold territory. But Shibani, do you also concur with that view? Because everybody has been waiting for that bounce to happen, not happening yet, and definitely can't say this for the broader end of the market. What is that is making still the markets nervous, Shibani, and what's your reading so far?
Yeah, hi, good afternoon. So when you look at the volatility that we have been experiencing since the beginning of this year, it's been a mix of both global as well as domestic factors. Money has clearly moved out of emerging markets, moved towards US. And today, when you look at the ratio, for instance, of MSCI EM to the S&P 500 index, that is at its lowest since March 2009. And that gives you a sense of how money has moved away from emerging markets, including India, which is clearly impacting our markets as well. On the domestic front, I think the biggest takeaway is on the earnings side, where earnings fatigue has set in and earnings over the last few quarters have been muted and similar trends seen in this quarter as well. Now, in this sort of a market, our belief has been for a while that risk reward continues to favor large caps, and that's a view that we continue to hold. Today, large caps are trading on a 1-year forward price to earnings multiple close to its long-term average. Mid and small caps have seen correction, and clearly valuations have also corrected from its highs. But even today, when you look at it from the perspective of its own long-term average, both mid and small cap indices, their premium still exists. And therefore, our belief is that the risk reward continues to be favoring large caps over mid and small caps at this point in time. Now, within the mid and small cap bucket, there have been stocks that have corrected considerably far more than what the index is pointing out to. And therefore, there one has to be cautious and look at stocks more bottom up in terms of picking stocks in this sort of a market. But clearly, the bias at this point in time from our portfolios continues to be large cap focused over mid and small caps.
Right, so stick with the quality large cap names at this point in time. That's the advice coming in from Shibani. But Shibani, sectorally, how do you see the picture panning out? Because in this recent sell-off, what we see is that financials haven't participated much. Other than that, it's been quite a mixed set when it comes to the auto pack. The pharma stocks, barring a couple of them, they are also holding on, and nothing much negative, or rather nothing much positive to actually read within the pharma space. And even when it comes to the FMCG basket, a similar sort of commentary. But what's standing out for you, Shibani, sectorally, and where should actually one can look at to go ahead and make some more investments in the large cap space?
Yes, so absolutely. So you are right to point out that, the banking sector, especially some of the large banks, which have underperformed in the last year, have been holding up better. This is a combination of a few factors. One, from a valuation perspective, they are trading at price to book multiples, which are lower than their long-term averages. ROEs for these banks, in fact, over the last 5-year period have expanded, and these banks don't require capital, which is why we believe that in this sort of a market, the banking space, specifically some of the large private banks and maybe a select few public sector banks which are large, are possibly well placed. Apart from banks, the other sectors where we think the overall earnings growth trajectory is likely to be maintained is one, the entire healthcare basket, and within that specifically the hospital space, where even in this last quarter, we've seen earnings trajectory remaining fairly healthy. And our expectation is that going forward as well, both on the domestic side of the pharma space, which is the domestic formulations business, as well as healthcare and hospitals, trends should remain fairly healthy. And therefore, that is another segment that we like in the overall basket. The third is the technology space. Here again, our belief is that incrementally discretionary spend should pick up, and that should provide some runway for top line growth going into next year. And with currency depreciation, some of the margin headwinds could be negated, and therefore margins should remain largely stable. And hence, in FY26, earnings trajectory should be better for IT, especially in context of what's happened over the last few years. And finally, in the consumption basket, we are looking at a few discretionary names that will benefit, especially those focused on the rural segments or even in the middle class segment, where post the budget, there could be some positive benefits coming through. So clearly, these are some of the sectors where we believe that, in terms of portfolio allocation, where we are positive at this point in time.
It's been a decent recovery from the day's lowest point, at least we can call that, because for now, Nifty 50 has once again rescaled to that 22,900 mark, and some of these heavy weights like Reliance, HDFC, if we can pull those intraday charts, we'll see that these heavy weights are definitely trying to lend some bit of a support to the index. But let's also welcome CA Rudramurthy on board. And hi Rudramurthy, good afternoon, and thank you so much for your time. First up, help us with some of the stocks that are standing out for you in this sort of a market, because it's a sea of red across. But any stock that you are liking at this point in time, and especially the kind of recovery that we are seeing?
Good afternoon and thanks for having me in the show. See, first of all, after seeing this kind of a massive fall and yesterday's Trump reciprocal tariff has been overreacted by market today, and I don't advocate definitely shorting at current levels. So no selling here. And on Nifty, you have a very, very crucial support at 22,700, 730 level. And we are very close to that very strong support. Similarly, if you see even today's intraday low on Nifty future as well as Bank Nifty future recovered from those lower levels of around 22,850 where the strong support lies. So this bounce back, whatever we are seeing, if you want to play on the short side, wait for further more recovery and then sell. Definitely this is not the place and time to sell market, but rather try to buy stocks which are relatively stronger, stocks which have given good results but it has not performed well on the price, or similarly stocks relatively like even in today's weak market which has done very well. One example similar to that which I have picked up today is Bharti Airtel and ICICI Bank. Look at Bharti Airtel, even in a weak market for last 1 to 2 weeks, stock has very, very strong supports at around 1,650, 1,680, and relatively it is a very, very strong chart. So I will be a buyer in Bharti Airtel. Stay with large cap for some more time till we see market momentum and buying on the upside. Avoid mid and small cap. Buy Bharti Airtel, look at targets of 1,775 and have a stop loss of 1,680. And similarly, even in today's weak market, one of the private banks doing very, very well is ICICI Bank. Charts are very, very strong. Look at targets of 1,280 to come on ICICI Bank and have a stop loss of 1,245 for this long trade. So a buy on Bharti Airtel and ICICI Bank, which are very, very strong in a relatively weak market.
All right, so that's the take coming in from Rudra, but let's take a look at what exactly the markets are doing. Yes, a very strong recovery at play right now for the benchmark indices. And it's very interesting to note, given the fact that the IT index is now actually turned into the positive territory. At one point in time, you had the FMCG index that was ruling the charts, but is the IT index trying to slowly creep into that sort of a territory? And Shibani, I'm not sure that if you discussed about this particular sector earlier on, but IT sector, this one is touted to be one of the biggest beneficiary of what could be happening globally. What's your take on this? And do you also concur with that view? And given if that is the view, then should you actually bet on this space?
Absolutely. So technology has been a sector where we have been positive on for a while. Our thoughts are twofold. One, near term, when you look at the US markets and the North American markets, which are a large contributor to revenue for Indian IT services, there is a clear trend of improvement where growth is concerned. And that should flow through in terms of some of the discretionary tech spends coming back on track, especially for large verticals such as BFSI, where again companies have been reporting fairly steady numbers where the US banks are concerned, especially the large banks. So that's one factor. Second, a more structural theme that we are looking at within the technology space is clearly the adoption of artificial intelligence and Gen AI. What we have seen in the past, and if you look at whenever technology changes have happened, Indian IT services players have benefited. And our thought is that while AI will lead to productivity improvements and there will be disruption, but overall, as AI adoption improves and increases, Indian IT services players are fairly well placed, and that provides a structural runway to growth. So, therefore, if you look at the entire pack, our belief is that one, top line growth should improve going into next year, which is FY26, and therefore earnings trajectory should also start to improve. Now, this is a sector where clearly from a balance sheet perspective, balance sheet trends are very healthy. This is a cash generating sector with companies returning back cash to the shareholders. Large cap IT names are still trading at multiples where in pockets you do find valuations which are reasonable. And therefore, there is scope to look at this sector from an overall perspective.
Right, so that's the take on the IT space. But Shibani, with this, we'll let you go on that. Really appreciate you taking the time out and speaking with us this afternoon.